Good afternoon, and thank you for tuning in to our first LinkedIn Live conversation of 2024. My name is Tim Maurer, and I'm the Chief Advisory Officer at Signature FD, a wealth management firm with a conviction that true wealth is bigger than just the accumulation of more. Joining me today are two highly skilled wealth advisors I have the privilege of working with, Dan Dubay and Matt Barber, who've dedicated their lives' work to helping corporate executives and entrepreneurs disentangle the inherent complexity in their financial planning and activate their wealth in pursuit of what's most important in life. Guys, it strikes me that there are some principles of financial planning that we've been studying and executing for years. There's a textbook version of financial planning, and these principles are universal, but the application of these principles can be very unique, perhaps especially with the types of folks that you work with. So Matt, you specialize in working with entrepreneurs in particular, and I'm curious what you found to be one of the more confounding aspects of your planning facing your clients.
Yeah, so in working with entrepreneurs, their plans do require a bit of customization. Typically, when we start working with a new client, their balance sheet is heavily weighted towards their company. It's not only their biggest asset on the balance sheet, but it tends to be the sole only source of income that they have as well. And so while this may not show up in your traditional portfolio allocation, it's something that we have to take into consideration when we're looking at their portfolio design, just given the concentration of their wealth. And the conversation around this concentration can be pretty interesting because most entrepreneurs don't necessarily see their business as risky, right? They have a sense of control, and typically they've been able to generate higher returns within their business than you could, making other investments outside of the business. And so the traditional analysis that you run around financial planning can be harder to implement with entrepreneurs because their cash flows can be a little bit more uncertain and potentially lumpy, right? And so running a long-term cash flow projection for them is a lot harder than your traditional client. Given the illiquid nature of their balance sheet, protection planning at the beginning also takes a more important role just to make sure that their families are taken care of if something were to happen to them. And then we also spend quite a bit of time talking about the optimal ownership structure of their businesses. And through that, we can potentially unlock some tax savings opportunities that they may not be aware of. Back in 2018, when we had the most recent tax law change, most individuals lost the ability to deduct state income taxes on their income tax returns, which is a big number for most entrepreneurs. And a couple of years ago, most states implemented the ability for these businesses to pay those income taxes from the business versus personally and take a federal deduction for those, which created some pretty material tax savings for those clients. We also...
All right, hold on, Matt. I asked for one confounding thing, and you just gave me like 5. Let's take one quick step back, because there's one I want to talk about in particular, and you mentioned right at the front end, and that is this concept of like risk tolerance. Like I'm picturing an entrepreneur filling out a risk tolerance questionnaire and seeing how woefully it may fall short, because here they're doing something that most of us consider very risky, right, in their entrepreneurial venture, and they may or may not take that approach at all with their financial assets. How do you kind of blend that labor capital risk that's inherent in an entrepreneur's world with that financial capital risk?
Yeah, I mean, we have some interesting conversations with clients, right? Because entrepreneurs in general tend to be risk takers, right? They have generated, a whole lot of wealth from the concentration that they've had in their business. And so, like, they understand it, they control it. Like, to them, every asset should earn 20 to 30% per year, right? And so it takes some education to allow them to understand that, hey, we need a safety bucket, right? Some safe assets that we can access if the economy or their business goes into any sort of downturn, right? Because we want to make sure that they've got the ability to weather that, right? And in most cases, come out of that even stronger. Back in 2020, most of our conversations with our clients weren't around, potentially going out of business or laying off people. It was, how do we capitalize on this opportunity, right? And if they didn't have, those safe assets, they wouldn't have had that ability to invest in their business at that time to take advantage of what they were seeing in the marketplace.
Yeah, it's interesting because we come back to that principle of the correlation between risk and return. But if you're an entrepreneur, your business doesn't feel riskier than that. That's fascinating. And Dan, we're fortunate enough to be headquartered in the great city of Atlanta, a place with a disproportionately high number of Fortune 500 companies. And you've had the privilege of working with a number of corporate executives, both inside Atlanta and outside. What have you found to be one of the challenges unique to them? We're talking about this concept of concentration. Does that apply within the community of corporate executives?
Oh, absolutely. When you look at the typical corporate executive, 50 to 75% of their balance sheet is in their company. That's where their wealth was created. So there are some similarities there, but at the same time, their balance sheet is being updated every day because that stock price is being adjusted throughout the day, where Matt's is a little bit different, where it's an accounting value. And so for us, we have to really be much more concerned about what does that look like and what if that stock has a downturn, or there's times where the company does well and the stock doesn't. And so how do we adjust that? And so your typical executive, about 50 to 75% of their compensation is equity based. It's
both
stock,
their
and it comes
compensation and their net.
Yeah. And so it parallel right there. And so you can see the correlation, but with that, those different forms of compensation have different risk and also different upsides. So stock options may have a lot more upside, but they also have some downside. You have performance share awards or LTIP that have a lot of does the company do well? So, for example, when you had COVID, you had Delta executives and Coca-Cola executives that weren't receiving their performance share awards because there's no way they could hit those numbers. Yet RSU still had value.
Sure, sure. I was just thinking when you talked about the impact of seeing your net worth effectively go up and down with the stock ticker on a given day because the company you work for is publicly traded. Do you see that as like a unique stressor with the folks that you work with because of the heavy impact that has on their own personal net worth to see what the stock's doing?
It's funny. Similar to Matt, I think if you look, they feel like they know their company so well that if the stock goes down 40%, they're less concerned than their diversified portfolio going down 20% or 15% because they know the company. Yet inherently, there's so much more risk. You have business risk, where in the market, you don't have that business risk. You just have the market risk. So it definitely can be concerning as they get closer to a transition away from the company to what's next for them, then all of a sudden that becomes much more of a factor, I think.
Yeah, it's fascinating. I'm thinking back to literal financial planning textbooks that we've all studied and qualifications that nobody should have more than 5% of their net worth in a single security. And that conversation is just completely out the door when we talk about executives and entrepreneurs. It indeed would not be in their best interest, and they would have no desire. They would look at us like we had lobsters crawling out of our ears if we told them, you're just going to need to trim all of that exposure down to about 5%, Mr. and Mrs. Client. Another concept that certainly is a universal and often considered a central topic in the realm of financial planning and wealth management is retirement. But Matt, what's the perspective that your entrepreneur clients have on the whole notion of retirement?
Oh, Tim, very rarely do we have a conversation with one of our entrepreneur clients around retirement. It's more focused around financial independence, right? Making sure that they've got enough wealth to do what they want to do, to live a great life. Very rarely does the entrepreneur stop working once they sell their company, right? Or, it's more likely that, the next conversation that I have with them is about their next venture, right? How should we set this up? Who should own it? How should we capitalize it? Once they feel like they've got the freedom to do what they want to financially, then it gives them the ability to follow their passions, right? And more often than not, they're starting something new rather than going and playing golf three or 4 days a week.
Yeah, it's fascinating to think about that being one of the primary ways even that an awful lot of financial planning software is set up. It's all about retirement or creating this light at the end of the tunnel, and these folks really have very little interest in that. I'm curious, Dan, when it comes to the impact on corporate executives, do you see anything unique about retirement showing up there?
Well, I mean, I think to Matt's point, they don't want to sit back and take life easy. They want to have an impact, but it is something where their paycheck needs to be replaced. And so so we try to create this base case of, okay, what does that look like and how are we going to source that and give you the confidence to then allocate other money to things that are really important to you. And so often we're preparing them to serve on a corporate board. How do they want to impact their community? What are ways that they can use their wealth, their time, relationships, and influences? And we have several clients here in Atlanta that sit on one client that sits on 6 different nonprofit boards to just make an impact in Atlanta, or another one that in Florida that sits on a community board, but then also has a goal to travel to all 195 UN countries. I think she's 135 in, and she integrates that with empowering women and mentoring women internationally. And so there's just different ways that they can have the freedom and the capacity that maybe they couldn't do when they were an executive, but they still want to have an impact. They still want to make a difference. And so it just looks different.
Dan, that's a great point. I do see a lot of times that our clients will go and start mentoring other entrepreneurs and helping them when they get to, when they reach financial independence, right? And kind of a way of giving back and helping that next generation. So it's definitely something that we see as well.
I love seeing that too, the way that entrepreneurs do seem to almost like bond together, like their own demographic, because I think the needs in their lives and the desires that they have, the word impact really seems to jump out in what both of you are describing. And it seems as though this whole notion of the duality of work-life balance, it also doesn't seem to fit these folks as much, does it?
Yeah, I will say things are never in balance. It's just, there's always, you're always cheating one thing and giving to another. But I think the key to them is they're difference makers, and they are going to allocate their time and their resources to the things that they think are going to have the most impact. And so often things they're moving to whatever is going to have the most impact.
Yeah, and also I just don't feel like they necessarily see it all as work, right? I mean, most of the time they're doing something that they love and that they're passionate about. And so it's not like they dread going to their, 9 to 5 every day, right? It's their baby. It's something that they've built, and it's something that they really enjoy doing too. And so when life is out of balance, right? Because Dan, I think you're right. I don't think it's ever in balance. It's just, you're trying to juggle and figure out where can I make the biggest impact, and where do I need to prioritize my time at any given, moment.
Yeah. Well, I think that's something that we thankfully share in common with our clients, is that we love the work that we do, and we appreciate the opportunity to do it. With all the complexities that entrepreneurs and executives face in life, work, and money, it's one of the reasons we help them simplify the magnitude of that task to a single page that we refer to as the Net Worthwhile Blueprint, including an articulation of the personal purpose behind their planning, a snapshot of the goals we've already achieved in 4 distinct areas of life, and a summary of the discrete goals we're partnering to accomplish in the year to come. Because the goal isn't simply to accumulate wealth for the sake of accumulation, in our view and the views of many of our clients, but to activate our wealth in pursuit of a better life. So thank you so much for joining us today, and please feel free to reach out to us with your questions and suggestions for future topics by emailing us at hello@signaturefd.com. That's signature, F as in financial, D as in design.com. Or check out our website at signaturefd.com. You will not want to miss our next LinkedIn Live conversation, and I know the two of you are going to be attendees here because that is going to be a focus on money and marriage, navigating financial harmony and disagreements in relationships. I want to offer a special thank you today to Dan and Matt for sharing their hard-earned wisdom, and to our friend and colleague, Crystal Mathis, for her and her team's work in making this conversation a possibility. Thank you so much, and we'll see you soon.